we're very pleased to have Brian Kelly. Brian is professor of finance at the Yale School of Management, a research fellow at the NBER, and the head of machine learning at AQR Capital Management. Brian will be talking about narrative asset pricing, interpretable systematic risk factors from news text. Brian?
All right, great. Thanks for the opportunity to present. So this is joint work with Leland Bybee, who's one of my students at Yale, and Yinan Su, who's at Johns Hopkins. And what we're looking at is trying to integrate essentially empirical asset pricing research with textual analysis. So there's going to be a number of things that we're trying to accomplish in this paper. Some of them are trying to develop sort of new ways to think about risk pricing from the perspective of information that's being revealed in text. But along the way, we run into a lot of interesting methodological challenges that we're going to be trying to tackle as well. So let's start with a little bit of motivation. I like to think about this paper from the perspective of the CAPM, although I think that nothing that we do here per se has to be viewed from a CAPM perspective. But let me give you the motivation in that context. All right, so if we think about asset pricing, we have a lot of multi-factor models that we use to understand behavior in the panel of asset returns. And the ICAPM has some specific statements about the way this behavior should look. Okay, so factors should represent beliefs and innovations in beliefs about the investment opportunity set. Those innovations should have some risk premium attached to them. All right, so when we think about what are asset pricing factors, they should be related to people's understanding about the investment opportunity set and how those are evolving over time. All right, now let's contrast that kind of theoretical view of what the CAPM is about with what we actually have in the empirical literature. What we have in the empirical literature are a bunch of empirical portfolios. They're characteristic sort of portfolios that stand in as asset pricing factors. And I think it's fair to say that these characteristic sort of portfolios have fallen short of what we would expect an asset pricing factor to demonstrate in terms of some sort of interpretable association with fundamental notions of risk. All right, so there's of course been a literature that's tried to investigate whether or not things like macroeconomic shocks can serve as effective empirical asset pricing factors, and by and large the answer to that question has been no. All right, so we're going to revisit that question, whether or not we can actually use interpretable risk factors that kind of fall under this ICAPM umbrella as viable empirical asset pricing factors by looking at news. All right, so one reason why macro shocks that you might say extract from information about employment data on GDP, things like this, why those might fail is because that's not the actual news revelation. When those numbers arrive, we can sort of measure shocks in the data from them, but the news is arriving in a different form. So what we're thinking about is that we'll go to the news directly. All right, we'll look at the text representation of when we think information is arriving, and we'll try and build factors out of the news directly. The hope is that by going directly to the news arrival process, we'll be able to capture something that is actually more in line with the responses in investors' beliefs and therefore more viable as an empirical asset pricing factor. Okay, so there are a couple of things that we're going to have to deal with as we go through here. So what are some goals that we're interested in here? So one is that once we start thinking about news, and particularly as we start thinking about news from the perspective of text, we know that we're going to be in a high dimensional empirical environment. All right, so to look at text data, it's unstructured. We'll have to put some structure on it. Generally, that structure does require a high dimensional representation to capture all of the information that's in that news. And now we're going to have to start thinking about what it means to estimate factor pricing models when we have a very high dimensional representation of the information that could be describing updates in investor beliefs. All right, so this type of new data is going to require some new methods, and I'll talk you through some of the innovations and the methods that we're going to do, that we're going to use for this analysis. It's going to be related to earlier work that Yinan and I have done on the idea of instrumented principal components, so ways of estimating high dimensional or ways for incorporating high dimensional information sets in conditional asset pricing models. But even in that earlier work, the high dimensions that we had in mind might have been on the order of, I don't know, a couple dozen conditioning variables. When we start looking at text, we're going to need much richer specifications to be able to deal with that. Once we start thinking about rich specifications, we need to start to think about how to control those specifications. So things like penalized methods and machine learning tools are going to be critical for us being able to accomplish this. All right. So that's going to be related to kind of how we approach the problem. That's going to be very closely related to the methodology point. And then we're going to move into asset pricing questions. Do our news-based factors correspond with things that can be thought of as ICAPM like state variables? All right, so what should such state variables do? Well, they should price assets, right? So they should have things like high risk adjusted return. They should be essentially spanning the mean variance efficient frontier. All right, we should find that after we sort of incorporate covariances of assets with these types of state variables, that there's not a lot of predictable price variation, alphas left over. And very important to the ICAPM perspective, if these are really updates in investors' beliefs about the future investment opportunity set, then whatever we decide on as our factors should also be predictive of future macroeconomic outcomes, things like future consumption, employment, GDP, and so forth. All right. Now, lastly, one of the great advantages of turning to news in the form of text is that text is inherently interpretable. The underlying data that is going to go into the construction of our factors is readable, right? And so we're going to show how the methods that we use can be sort of exploitative of the fact that we're using text to better arrive at a deep understanding of what it is that we're accomplishing, of what it is the factor model is grabbing onto. I want to emphasize that all of this stuff, I think, is a very early stage research agenda, right? The use of textual analysis, the use of news in financial economics is really in its early stages. So a lot of the stuff that we're trying to propose here, they're imperfect solutions, but I think they're moving in the right direction. And I expect this to not be a complete or a perfect answer. And hopefully there will be a lot of good work improving upon this over time. All right, so let me start with data. All right, the data that we're going to use for our news is going to be the Wall Street Journal. All right, so we've studied the Wall Street Journal quite a lot in our past research. Okay, so for example, Leland and I have a paper that I presented at this conference a couple of years ago, looking at latent Dirichlet analysis, so topic analysis of the Wall Street Journal. And in that paper, we go through and we essentially say, what is the structure of news in the Wall Street Journal? What is the structure of business news? And how does that associate with macroeconomic fluctuations? So that paper, I encourage you to take a look at it. It's called Business News and Business Cycles. And one thing that comes out of that paper is really a first estimation of the structure that essentially describes the behavior of market news, okay? So we chose the Wall Street Journal sort of very specifically. What we wanted to do was have a news outlet that's sort of mostly focused on business and economic related phenomena. And so we're thinking about the structure of business news as being the stuff that's most likely related to asset prices. But as the previous paper in this conference describes, there's obviously a lot of other types of news that might be related to asset pricing as well. In any case, we're starting from the Wall Street Journal as our first pass. And again, that's like a great direction for future research to think about more expansive news data sets to bring to bear on asset pricing. All right, we're going to start from the Wall Street Journal. One thing that comes out of our estimation of the topical structure of the Wall Street Journal is that you need a lot of topics to capture the behavior of it. All right, I think this is not so surprising, right? In our data set, we're looking at essentially like 40 years of the Wall Street Journal. How many topics, how many recurrent topics do you need to kind of capture the joint variation of narratives in the Wall Street Journal? Well, that's a statistical question. And when we asked that statistical question, the answer that we got out was about 200 topics. 180 in particular is what we settled on as a statistically optimal number of topics for describing the Wall Street Journal. So right away, we see that we have a high dimensional representation of the news space that we need to work with in order to bring that to bear on asset pricing questions. All right, so one thing that I'd point out, I'm not going to be able to go through a lot about our estimation of the text model for the Wall Street Journal. That's content that I would just refer to this other paper for. But all of the information for that estimation is on this website, structureofnews.com. We can take a look at that. You can go through, look at the list of topics, look at their time series variation, and so forth. Get a good flavor of what it looks like. I'm going to give you a very kind of quick summary of what some of the topics look like in that data set. So first of all, we have 180 topics. It's really hard to show all of them at once, but a lot of the topics are related to each other. They can be aggregated into what we call meta topics. Okay. So one thing that's interesting about the structure of the Wall Street Journal is that the meta topical structure of it is actually quite stable over time. So for example, there's a group of topics that relates to information about banks and asset managers, topics about markets, topics about economic growth and certain technologies, topics about science, culture, and so forth. All right. What this plot shows is that over time, the allocation of news content to each of these meta topics is fairly stable. All right. It fluctuates, and those fluctuations are going to be interesting. And it's going to actually be the content of some of the belief updating that we're going to estimate. But at this kind of zoomed out level, metatopical content of the Wall Street Journal is stable in its allocation over time. Now, within these metatopics, we have subtopics. And in some of these subtopics, you see some pretty interesting fluctuations. So I don't want to spend too much time on this, but let me show you one example. So we have a metatopic on technology. That technology metatopic consists of a number of subtopics. And this is where you see some interesting churn in the content of news over time. So for example, in the 80s, when the Wall Street Journal was talking about tech, they were talking primarily about computers. All right, it's talking about mainframes, talking about the advent of personal computers and so forth. Over time, discussion of computers has narrowed quite substantially. And it's been supplanted. It's been supplanted by a couple of things. First, it was supplanted by internet, and later on by mobile devices. Okay, so we're able to track coverage of each of these individual topics in the news over time. And by understanding the fluctuation in this coverage, we're going to start to understand how investors are updating their understanding of the economic world around them. Okay. All right, so these are going to be some of the raw inputs. This is going to be the representation of the text that we bring to asset pricing models. All right, so now the next question is going to be, how do we use this representation of the text to try and estimate what an appropriate factor model is? All right, now the way we're going to think about this is, I have each of my 180 topics that I've estimated from the Wall Street Journal. As time passes, coverage of those news topics fluctuates. All right, I want to think about innovations in that coverage as being shocks to a state variable. How much time we're talking about the Fed, for example, as that varies over time, innovations in that is going to be a shock to a state variable that might influence an investor's belief about the future opportunity set. All right, so I have, in essence, kind of bringing this to more traditional language for doing empirical asset pricing, I have, in essence, 180 non-tradable factors that I'd like to do my empirical analysis with. So if I want to bring this to bear, for example, on questions relating to the cross-section of stock returns, I have to be able to manage an estimation problem where I'm considering betas on 180 non-tradable factors. I have to imagine being able to build tradable versions of those non-tradable factors, and then doing asset pricing tests, alpha tests, risk premium tests associated with those. So it's a non-trivial issue given the dimensionality of the factor set. So one thing we could do, this is the naive solution, would be to just build 180 factor mimicking portfolios and then treat those as asset pricing factors. We're going to do something that is a little bit more, more thoughtful and more dynamic than that. So there are two things that I really want to inject into this analysis. One is that I want to recognize that 180 factors is very likely too many factors to be considering in a model. And so I'll want to have an approach for sort of selecting among these factors the ones that are most influential for asset prices. Right? And on top of that, I want some conditionality in my model, because we know from a lot of the work that I've done in the past and a lot of work that others have done in the past, that low dimensional factor models have a very difficult time explaining the cross-section of asset prices without additional conditionality in things like the betas on those factors. All right, so the first comment here is designed to kind of get a little bit more specific about what some of the empirical issues are that we would like our method to address. So for example, we have lots of topics that proxy for different types of risks. For example, things like economic growth as a topic, recession as a topic. How different are these from each other? Are some of them capturing the same risk? We have other topics that may not actually represent asset pricing risks. So for example, there's a gender issues topic that we estimated. Very important topic for thinking about sociology and human behavior more generally, but may not be a very relevant topic for thinking about fluctuations in asset prices. That's a question we'd like our empirical method to be able to ask: which of these topics, or which subsets, which perhaps linear combinations of these topics are best suited to serve as asset pricing factors. We don't want to be sort of taking researcher views too heavily into account up front, and we want our method to be able to decide what are the appropriate topics to include in our model. Okay. All right, so let me give you a flavor of how we're gonna model this. I'm not gonna go too in-depth into sort of the technical formulations, but I'll give you a bit of a sense. So this is the general model formulation that we want to be working with: a conditional factor pricing model. We have betas that vary over time. All right, these betas are going to be where our text estimates come into play. Okay, so we have many factors. We expect them to be associated with the news news coming from the Wall Street Journal. We need to estimate conditional betas on these factors. Okay, so the way that we're going to do this is we're going to estimate conditional covariances between each of our assets and the topic attention allocation for each of the factors. So think of this as, for each stock at each point in time, I'm going to calculate the beta between that stock's return on a daily basis and the daily innovations in Wall Street Journal coverage to each of the topics. All right, so this is a traditional first step in Fama-Macbeth when you're trying to estimate betas on non-tradable factors. All right, we're using daily data to make these beta calculations conditional. Okay, so we'll be doing these covariance calculations within each month. Now, the second traditional step that we would use in Fama-Macbeth is, once I have each asset's covariance with each of the non-tradable factors, I'd run cross-sectional regressions. Those cross-sectional regressions recover tradable representations of the non-tradable factors. Okay. Once we have that, the typical Fama-Macbeth follow-on step would be to start to evaluate alphas and risk premia associated with those estimated tradable factors. Now, as I mentioned, these tradable factors, which I'm calling H here, right, they're 180 dimensional, and we think that's likely to be too many. And in fact, if you estimate these, you'll notice that, for example, you'll find a lot of near collinearity in some of these factors. You'll find some of them are just have low covariances with many assets. In other words, what we see is that among these 180 tradable versions of the Wall Street Journal news narratives, many of them are sort of irrelevant for asset prices. So what we want to do is we want to replace this high dimensional factor set with a compressed version of it. Right? So this gamma FT, again, without going into a ton of detail, think about FT as a dimension reduced version of our high dimensional tradable factor set. Right. Now, how do we actually do this estimation as a methodology that, again, Yinan and I have written about in a previous paper that we call instrumented principal components analysis. And it gives you a method for recovering such latent tradable factors when you have these high dimensional information sets that constitute information about betas on those factors. All right, so we've estimated these conditional covariances. Those are going to be our proxies for conditional betas on factors, but we're going to now compress the dimensionality of the system so that we have a low number of factors, 3, 4, 5 factors, the types of dimensionality of a factor model that we're used to working with in finance. All right. So I have a little bit of detail on how we actually approach the estimation problem here. But something that we need to keep in mind is that once we start pushing the dimensionality into sort of the hundreds of factors dimension, this becomes a difficult estimation problem in the sense that there's propensity for overfit. Right, so we want to start to eliminate some of that propensity for overfit. We want to reduce dimensionality, and we want to encourage the model to focus on a relatively small number of the most important topics. So what this estimation algorithm is going to do, it's really a penalized least squares estimation algorithm. What it's going to do is try and zoom in on the topics that have the best ability to explain covariances and average returns across a large collection of assets, right? So I think that's the right intuition for what we should be asking a statistical objective function to do in an asset pricing model. And this is the particular formulation that we've developed to do it. I think there's a lot of sort of interesting methodological insights that go along with this. I'm going to have to gloss over those for the purpose of this presentation, but again, I encourage you to take a closer look at the paper if you're interested. All right. Now, one thing that I want to emphasize here is that we are trying to construct this low dimensional factor set F. This low dimensional factor set is not just an arbitrary construction from returns. It is predicated on covariances between returns and the Wall Street Journal text, okay? This is an important anchor. We're not allowing any information other than news text to dictate how we construct factors to represent these returns. All right, so we're really trying to preserve an underlying interpretability of the factors that I'm going to come back to towards the end of this presentation. All right, I don't want you to be thinking of this as this is just another empirical representation of returns that's done some dimension reduction via something like PCA to get us to useful factors. No, these factors are fundamentally anchored in covariances with text. We aren't allowing ourselves to build factors that are differentiated from that. All right, now, what is the exact number of factors that we should work with, and what is the exact configuration of the topics that we should be admitting into our model? We have a particular way of selecting this. It's very closely related to a lot of sort of the machine learning paradigm, which is we need to be doing some model selection. We have an entire spectrum of models at our disposal, from very small models that are heavily constrained, a small number of parameters, to very large models that use many parameters and are much less constrained. And we want to pick a model that has a high likelihood of performing well on an out-of-sample basis. All right, so this is the entire sort of modus operandi underlying machine learning. We employ some of these tools here to select an appropriate model specification. I'll tell you a little bit more about what some of these specifications look like momentarily. All right. Now, at this point, we've gone through it pretty quickly, but what we've done is we've developed a methodology to take textual representations of news and convert those into asset pricing factors. Next, what I want to show you is what the actual performance of these factors look like in a number of asset pricing tests. So now this is going to be the territory that's more familiar to sort of the traditional asset pricers on the call. We're taking these factors that we've constructed from text, and we're going to be running AP tests. Okay, so what does the sample look like? Well, our digital news text is available starting in the mid-'80s. All right, when we estimated the topic model for the news, we went through 2016. We have an in-sample estimation to build a model. We have a particular way of doing value validation. All of our analysis in terms of the performance of our asset pricing models is going to be on a purely out-of-sample basis. Okay, so any statistic that I show you from here on out, think of this as this is purely out of sample. It's after I've chosen a model from an entirely distinct time sample, right, earlier in the data set. We have results in the paper both for just split kind of half-half in sample, out of sample analysis, and then we also have results for sort of expanding training windows like is frequently done in the asset pricing literature when trying to do out of sample analysis. The results tell the same story in both cases. So let me show you a little bit here. All right, so what I'm reporting here are different model specifications for our estimated factor model, ranging from if I use the text to construct one asset pricing factor, two asset pricing factors, all the way up to a 6-factor representation. The reason why I'm going up to 6 here is because I'm going to be making some direct comparisons with existing asset pricing models, right? And the largest asset pricing model that we work with from the extant literature is the Fama-French 5-factor model plus the momentum factor. So we call that the Fama-French-Carhart 6-factor model. All right, what I'm reporting for these factors here are the Sharpe ratios, okay? So these Sharpe ratios are, so these are going to be the out-of-sample Sharpe ratios of the mimicking portfolios of this dimension reduced factor representation of the text. Okay, so there are a couple of things to kind of keep in mind as we go through here. So as I suggested, we're doing a penalized regression. All right, we're doing essentially a penalized estimation to try and control the dimensionality. So there's a question of, in our training samples, how many of these topics are actually being represented in our asset pricing factors? So you see that the average number of narratives in a 1-factor model picks up about 3 topics. All right, when we go to a 3-factor model, we tend to use about 12 topics and so forth. All right. Now, what do the Sharpe ratios look like? This is going to be a first indication of the mean variance efficiency of these portfolios, okay? So if I'm looking at, say, a 4-factor model, what I'm reporting here is the out-of-sample Sharpe ratio of the mean variance efficient portfolio, the Markowitz portfolio of the 4 factors that I've constructed. All right, again, this is a completely out-of-sample evaluation. And what we see is that with text factors alone, we're able to construct an out-of-sample a factor model that has an out-of-sample Sharpe ratio, essentially an SDF Sharpe ratio. It's designed to be the maximal Sharpe ratio in the economy subject to this text-based factor representation of 1.26 in annual terms. All right, this is an indication that this model is going to be pretty well situated to explain cross-sectional differences in average returns, right? The duality is that you have high Sharpe ratios of the mean variance efficient portfolio of factors in your model. It's equivalent to having small alphas in your cross-section of assets. All right, so we have some comparisons here. If I build similar mean variance efficient portfolios from the Fama-French factors, you see that the mean variance efficient portfolio sort of peaks around 1, right? And this is when we haven't constrained the factors that we've built to be associated with text, right? So the summary conclusion from this slide is that we built some asset pricing factors that, despite being anchored tightly to text, actually are able to do a good job of explaining some of the large differences in average returns across assets. So we want to investigate that a little bit more closely. So the way we do this is we start to calculate alphas for sort of well-known asset pricing anomalies on these news-based factors. So what we're going to use as our test assets here are 76 anomaly portfolios. So these are kind of all the usual suspect anomaly portfolios that people study in the literature. To give you a flavor of what the alphas for these portfolios look like, the average monthly alpha relative to a Fama-French-Carhart 6-factor model is 27 basis points, right? With news factors, you would think that it would be difficult to have such low alphas achieved from a pure text representation. But in fact, with our 4, 5, and 6-factor models, or 2-factor models, well, we're talking about achieving average absolute values on the order of 21, 22, 23 basis points. Okay, so very competitive in terms of explaining cross-sectional differences in average anomaly portfolio returns, but again, doing it via this restriction to having factors anchored to text. All right, we can look at I'm running a little bit short on time, so I'm going to move beyond this. We can look at this in other asset test assets as well. So for example, if we look at the size and book to market sort of portfolios from French's website, you see Fama-French model does especially well here as it's designed to do. But nonetheless, even in this set of portfolios where Fama-French is designed to do especially well, we are reasonably competitive in terms of the alphas from text-based factors. All right. Now, we have a factor pricing model, It has a high degree of mean variance efficiency among its factors. It produces low alphas. It does a good job of explaining differences in average returns across anomaly portfolios, but is it an ICAPM factor? All right, so to investigate this, the standard recipe would be to take your factors that you've constructed, which are designed in the ICAPM to represent innovations and beliefs, and actually test whether or not those innovations and beliefs associate with future outcomes. In a genuine ICAPM world, investors are making rational belief updates. As they update their beliefs, they should be having better information about what's going on in the future. So we can run a regression to test this. This is kind of fairly mechanical way that people have tested the ICAPM in the past. What I'll do is I'll look at innovations in different macro variables in subsequent periods up to, let's say, H periods ahead. Okay, so these are going to be cumulative future changes in things like unemployment, GDP, and so forth. And I'm just going to regress those on my contemporaneous innovation. I should say my lagged innovation. This is a time T innovation in my SDF and how this forecasts macro outcomes in all periods subsequent to T. All right, so let's look at what this, what these results tell us. So the main point is that generally speaking, our SDF, when it updates positively, is telling us that future opportunity set is going to be better. Does that bear out in the data? It does, right? So when we have a positive increase in the SDF, right, we see that it associates with expected higher S&P 500 outcomes, increases in consumption growth, increases in GDP growth, decreases in unemployment, and so forth, all right? So these are noisily estimated, but the estimates go in the right direction. We look at this as supportive of the ICAPM view. All right. Now, the last thing that I want to talk about, I have about 5 minutes left, is to delve into interpretation a little bit. All right. So one thing that we get from working with a text-based model of factor pricing is that we begin with the text, we estimate a model to get to the topics, and from the topics, we estimate a model to get to risk factors. We can reverse this analysis as well. Once we know what the risk factors are that get selected by our statistical algorithm, we can reverse engineer and say, okay, what are the text narratives that eventually flowed in to the factors that we built? All right. So without going, there are specific mathematical formulas that will allow us to do that reverse tracing from the risk factor estimates to the raw text. But let me just show you what you get once you do this tracing. So what are the topics that show up as important contributors to our factors? Well, remember, there are 180 topics. We've used a statistical algorithm that tries to put weight on only the most reliable topics that associate with asset returns. Many of these get zero weight because of that algorithm. Many of them get zeroed out because they're just not important. These are the top 15 or 20 topics in terms of the ones that have received weight in our factors. And you see that even those are dominated by just a handful of topics. All right, so these topics, by and large, talk about overall macroeconomic activity, in particular recession activity. All right, so these are narratives that associate with people's beliefs about future economic activity, and narratives that have to do with market activity. Okay. Now, I think in an ideal world, we would have narratives that broke down each of these types of discussions and even finer terms, and we can go in that direction a little bit. But as I said, I think about this as sort of early stage in this research agenda. And hopefully we can make more progress on this going forward. Let me trace this back to some specific headlines that we can show actually feed in with heavy weight to our ultimate factor estimates. Okay, so here are some examples of the headlines that got the highest weight in the highest topic that contributed to our most important factor. All right, so 1993, we have a headline, auto registrations continue to slump in Europe last month. 2001, consumer confidence slides on fears of layoffs. And we have manufacturing slowdowns, consumer sentiment slowdowns, and so forth, right? Here are some examples of things that show up in the market topic. Here are some examples of headlines that show up in the trading activity topic. The model gives you a vehicle for going from the final factors that you estimate to the underlying articles that are most closely associated with those factors, right? This is the sense in which you are able to recover narratives from the model that we've estimated, all right? And this is exactly the sense that we refer to these as interpretable factors. They can be traced to the underlying narratives. All right. I think what I'll do is I'll wrap up with that. So what do we do in this paper? We extract narratives from the Wall Street Journal and ask whether or not those are productive as asset pricing factors. We try and integrate this via an ICAPM perspective with the idea that we're going to take this news literally, right? News that updates investors' beliefs is exactly the type of information that shows up as the SDF in an ICAPM world. We estimate that directly, and we show that it actually has reasonably good pricing power for cross-section of assets. Along the way, we have to recognize that dealing with text, we're using very high dimensional data representations, and we need some methodologies to accommodate that. So we've extended our IPCA model to handle kind of machine learning settings, very high dimensional settings with penalization. I just reiterate once again, I think that there's a lot of room for improvements on this. I very much encourage people to kind of move in this direction. And I want to thank the organizers once again for including us on the program.
Okay, thank you, Brian. We have time for questions. Brian, do you want to handle the questions? Call on people?
Yeah, Mark, go ahead.
Thanks, Brian. This is interesting and I think important questions, and I love the directness with which you're taking the information in news and thinking about what it does for helping us to understand drivers. Help me to understand something I see as a conflict, even in your last slide. You talk about recovering things about future prospects, which sounds like the cash flow side. And yet you frame this as being about the risk factor, the discount rate side. And when we think about factor models, we're really focused on the risk, on the discount rate. And when I see this exercise and the things you tie it back to, I think Diego's eating with his mic on. Maybe you could turn that off.
Maybe mute yourselves.
There you go. Could you help me understand the distinction you have in your mind between prospects, cash flows, and the numerator, and the discount rate as the denominator? Because I see a blend here.
Right.
And I need a little more clarity, because news and even the news events you identify really do seem to be cash flow, not discount rate.
Yeah, absolutely. So, I mean, for all the amazing things that we've learned from John Campbell and Bob Schiller over the years, I think one disservice they've sort of done to the profession is this distinction between cash flow news and discount rate news. They are extremely difficult to disentangle. And in any structural model, cash flow news is also discount rate news, right? I should say maybe not in any, but in all of our canonical structural models, okay? So if you talk about anything like, let's take a long run risk model, for example, we have shocks to the investment opportunity set in the form of volatilities about future consumption growth, right? That's a shock to the distribution of a fundamental, but it is also the main determinant of discount rates, right? So in an ICAPM view, the exact same thing is going on. That's essentially an ICAPM world. And I think of that as actually being a very reasonable sort of analogy to the type of ICAPM world that we're looking at here. So we have innovations in our understanding of what the current state of the economy is, okay? Some news arrives, all of a sudden we're talking about an article where a tool manufacturer laid off a number of employees. We say, okay, I see that news. That's indicating to me some increased probability of a future economic slowdown. I update my beliefs accordingly, all right? And that update is a realization of a risk that I take into account ex ante. And that risk that I take into account ex ante is what we would call the discount rate, okay? So by measuring things that have predictive power for future economic outcomes, we're also measuring the risk that determines our risk discounting, right? So I think this is actually all sort of internally consistent, and it is exactly the rationale I think that Merton had in mind with his CAPM. So this is, I mean, I'm sort of excited about this particular ICAPM interpretation. It's not a perfect interpretation, right? I think of it as a useful device for sort of explaining what we're doing in this paper. But if people have a different view that, listen, you're capturing some fluctuations that investors are paying attention to in some way, they serve as good asset pricing factors, and I want to be thinking about this from a different interpretation, I'm also open to that as well.
Thank you.
So Brian, I would like to ask you a follow-up question. It's actually very related. I mentioned it to Gina when I discussed the paper a few weeks ago, which is that this issue, you're taking a very strong stance on this being risk-based ICAPM type SDF, if you wish. I mean, you're picking up some SDF, and obviously you're managing to price things very well. But it could very much be animal spirits, right? Your specification cannot really distinguish about, are these really risk factors, or is this just, you know, sentiment coming through the journal?
Right. Okay. So I'll take that comment. I think I agree with it. I think my response to Mark is very much along those lines, right? I don't think we're sort of, I don't know, in any kind of statistical or formal sense, ruling out alternatives. What I'm excited about is that we have a bunch of asset pricing factors that have become sort of the cornerstone of the way we do empirical research in finance, with essentially no ability to link to what we would think of as a theoretically grounded risk-based underpinning, right? And this gets us a little bit closer. I don't think it gets us all the way there, right? I cannot show categorically that we've nailed, right, the fundamental CAPM style factors that Merton had in mind, right? But I think we're making progress because we see that these things are linked very clearly to beliefs. The source of those beliefs are news arrival, right? And that they actually have predictive power for future economic outcomes. So, you know, as I tried to say all along, I don't want to think about this as like a very dogmatic view that this is a CAPM model and that's what's happening in the world. That's what we're measuring with the text. That's what's showing up in returns. What I want to say is that this is sort of a relief for asset pricers that there's some evidence that something along those lines appears to be manifesting in the data. Right.
Thank you so much, Brian. So I thought it was a fantastic presentation and fantastic paper as well. You know, I wish I'd written the paper. It's a fantastic paper. So one really simple and naive thing I was thinking throughout the talk was, and this also relates to your other work with Leland, is instead of doing the IPCA thing to reduce dimensionality, an alternative to that, a really naive one again, one that I've used in the past, and you know, this has a rich tradition in textual analysis, is just kind of doing a simple PCA on the topics themselves, and just looking at that covariance matrix, you know, finding the eigenvectors that explain the most variation, taking the first, you know, couple principal components, whatever, and taking a look at those. So, you know, I did that in ancient times about 20 years ago, and found something not that different in the sense that, you know, positive and negative words are really important. I bet the, you know, recession and problems topics kind of load heavily on those types of things. What would you find if you did kind of, instead of the IPCA, just did this really simple and naive thing? And how would that be different? Can you speak to that?
Yeah, that's a great question. So in this context, we actually haven't tried that. In earlier analysis of the Wall Street Journal text, we did try that. And I think that some aspects of what we're finding are preserved, and in particular, the aspect that you just alluded to, sort of this notion of positivity and negativity, does get preserved in the leading PCs. But what you end up doing is essentially mixing together many topics, right? And so, you know, whether or not it's the pure positivity or negativity that's driving what we're finding here, that's a great question. I think we can deliver a very specific empirical answer to that. We should definitely look at that. I love that idea. but it would lose much of the flavor of recession, for example, which is very tightly anchored to things like economic growth type of words.
Absolutely. You could even just do linear combinations of your existing topics rather than,
Yeah.
taking the positivity and negativity lexicon. Just use the lexicons from your topics too.
Right, right. It's a great suggestion. Thanks.
Thank you.
All right, well, I think that brings us to the end of what I think was very interesting and enjoyable conference. On behalf of the organizers, that's Harry Mamaysky, Paul Tetlock, Melina Dennebaum, and myself, I want to thank, first of all the speakers and panelists for their participation. That's really what makes the conference work. And thanks also to all of you who attended and participated. So let's give a round of applause to all of the speakers.